Right now, the Treasury is quietly modeling a 20% tax on your assets if you're thinking of leaving the UK. Multiple outlets, The Times, The Guardian, The Independent, have confirmed it. You can leave the UK, but not with all your money. At least that's what the Treasury's new plan suggests. A 20% settling up or exit tax for people moving their wealth abroad. Here's what it really means and who's about to get cut out. For years, wealthy business owners have been able to leave the UK, move to a low-tax country like Dubai, and pay zero capital gains tax on the wealth they built here. Once they change residence, the UK can't tax them, even if they sell their business the next day for millions. It's perfectly legal, and the Treasury knows it. But from their perspective, that's a massive leak in the system. The UK provides the infrastructure, legal protections, and tax reliefs that helped create that wealth, yet none of that gain is taxed if the person simply leaves. So, this new 20% settling up charge is basically the government saying, if you built your fortune here, we want a final cut before you go. And if you think this idea came out of nowhere, it didn't. In October 2024, the London School of Economics released a study arguing that the UK should bring in an exit tax just like France, Australia, and Canada. They found that between April 2023 and April 2024, UK business owners took over £5 billion in company shareholdings with them, costing the Treasury an estimated £500 million in lost capital gains tax. And nearly 3/4 of that wealth ended up in tax-free jurisdictions. The London School of Economics called Britain an international outlier for not having an exit tax while countries like Australia and Canada already do. Their recommendation was simple. When people move here, reset the tax base. When they leave, tax the gains made while they were UK residents. Now, a year later, that's exactly what the Treasury is exploring. And if this sounds extreme, it's not new. Other G7 countries already have versions of this rule. The US goes even further. If a wealthy American gives up citizenship, they face an expatriation tax on their global assets. And there's already a precedent here in the UK. When a UK company moves its tax residents abroad, it faces a corporation tax charge on all realized gains based on market value. The same applies to trusts that become non-UK residents. So, the Treasury's logic is simple. If we already make companies and trusts settle up when they leave, why shouldn't individuals do the same? Technically, the UK already has exit charges not just for individuals yet. So, what would this actually look like in practice? When someone permanently emigrates, their unrealized gains, meaning the growth in value of their assets up to that date, will be taxed at around 20%. It's aimed at high net worth individuals, not the average person retiring abroad. In other words, if you built a £10 million gain in your company while living in the UK, you owe around £2 million in tax before you even sell it. There might be a deferral option, letting you delay payment until you sell, but the liability will still be locked in the day you become non-resident. Here's where it gets interesting. The Treasury needs money fast. There's a £30 billion fiscal gap, and raising income tax will be political suicide. Even though Rachel Reeves has hinted she may be prepared to break that manifesto pledge. Some say it's fair to make the wealthy contribute more. But judging from the Chancellor's pre-budget speech last week, it sounds like everyone will be chipping in to fit this black hole. The problem is, high net worth individuals have already been leaving the UK in large numbers. Announcing a tax like this could push even more to go. And if it's not implemented immediately, it could trigger capital flights as people rush to leave before it takes effect. That would do the exact opposite of what the Treasury wants. They believe this could raise around £2 billion a year. But whether it actually delivers that depends entirely on timing, enforcement, and how people react. There's also a risk that it could deter people from moving to the UK in the first place, which is a real problem for a country that depends on global talent and investments. This isn't just about one tax, it's about a bigger shift. Governments are moving toward taxing wealth and mobility, not just income. So, plan ahead. Talk to a qualified tax professional. Review how your assets are owned, when your gains are realized, and what your long-term residency plans actually are. This autumn budget is shaping up to be one of the most significant in years. A cap on salary sacrifice schemes, a freeze on income tax thresholds, even the possibility of increasing them, and now potentially an exit tax. The UK is finally catching up with how other countries tax wealth leaving their borders. And whether that's fair or not depends on where you're standing. Either way, it's coming. Thanks for watching, and I'll see you in the next one.